Welcome back. Owen's here now for a look at the day's business news. Hello, Owen. So the European debt crisis well and truly back on the agenda today with the leaders of France and Germany meeting in just a couple of hours' time.
Absolutely, yeah. And as you'd expect, it's always the case, isn't it, going into these sort of get-togethers, the markets think, what are they going to do? Are they going to resolve this European crisis? Probably not at this summit, that's for sure. So lots of jitters. The European markets opening just a little bit flat. There they are for you, in the green at least for the time being. But let's see how they pan out over the day with whatever Messrs Sarkozy and Merkel talk about. We're expecting a news conference from them around about lunchtime. The Asian markets, a real reversal of fortune, reversal of losses, I should say, particularly for the Shanghai Composite, nearly 3% up just before the close after some fairly encouraging comments from the Chinese Prime Minister about allowing private investment into banks and insurers. The Nikkei is shut today, or was shut, I should say, for a public holiday.
Now, one stock to watch is HMV, the UK's high street music retailer. It's in real trouble.
Absolutely. You don't have to be any real forecaster of trends to see that people just aren't buying CDs and films on the high street these days. And so it's proved for HMV. Over the Christmas period, its total sales were down 9%. This company is in real trouble, even in its statement, in its trading update this morning, saying that it wasn't sure that it could remain as a going concern for the months ahead. Worth just noting as well, our earnings board, HTC, the Taiwanese smartphone maker, its shares down after recording a fourth quarter income of just over $360 million. But that's 26% down. That's the first time in years that it's recorded a loss, or recorded a dip, I should say, not a loss, for that period of time.
Now, as Owen was just saying, some market hesitancy over the Sarkozy-Merkel summit. One issue closely watched by banks and hedge funds will be a Eurozone-wide tax on financial transactions. The billions raised would be used to help fund future bailouts, but critics say the idea risks isolating its biggest fan, France. Here's Karen Creed.
40 years after the idea first originated and Nicolas Sarkozy's determined to implement it. Tobin tax was originally proposed by economist James Tobin in 1972 after concerns that the rapid movement of money across borders was making it difficult for governments to pursue the right monetary policies. The French president is adamant it's the right way to raise revenue in recessionary times.
When you buy an apartment in any part of the world, you pay tax. When you go to the supermarket to buy food, you pay tax. Yet when you make a financial transaction, you don't pay tax. It's unbelievable.
The levy would impose a 0.1% charge on trading shares and bonds. Current proposals mean the tax could generate an estimated $57 billion in revenue for EU governments. ECB chief Mario Monti has urged France not to move ahead of its EU partners without agreement, while French economists fear it could be detrimental.
The great danger for France today is not only that we find ourselves isolated financially, and to see a flight of money, we don't need that right now. Another danger that we don't highlight, something that's not well perceived, that it could destroy the French finance system.
But Sarkozy remains adamant and is set to step up efforts to push it through at an EU summit later this month. He's threatened to go it alone if the rest of Europe doesn't agree a tax by the end of the year.
Well, as you heard there in that report, the UK is no great fan of the Tobin tax and has said on many occasions in the last few months it will not sign up to that kind of financial transaction tax. That isn't to say that the government isn't interested in some sort of financial reform, and it appears that curbing in banking bonuses is back on the table. The Prime Minister David Cameron was speaking on Sunday, drawing up plans to try and rein in what he says is excessive growth on bonuses. One of the ideas would be to give shareholders a binding vote over pay. At the moment, it's a fairly discretionary kind of affairs, but there's no real commitment for employees to be included on executive pay committees. So lots of analysts say they're not really sure that those proposals will be as radical as they first sound. There's certainly nothing on the table like the one-off tax on banking bonuses that we had a couple of years ago. All of this in the context of a new outcry over the head of Royal Bank of Scotland's investment arm, who's due to enjoy a £4 million bonus this year. Remember, RBS was one of the UK banks bailed out by the UK government and is now majority owned by the UK taxpayer. A bit more company news, I think, for you. Let's get a few more of the day's company headlines. Olympus is preparing to sue a host of former and current executives over their roles in the false accounting scandal. The Japanese camera maker has confirmed it's considering legal action and is understood to be targeting around a dozen senior staff who covered up nearly $2 billion of losses, allegedly. The firm is already being sued by its former chief executive, Michael Woodford, who blew the whistle on the case. On Friday, he dropped plans for a full takeover of the company.
Nokia is pushing its Windows Phone deeper into the US market by announcing a deal with AT&T. Bloomberg sources say the Finnish phone maker will unveil the partnership at the Consumer Electronics Show in Las Vegas later this Monday. Nokia is trying to turn around its fortunes after losing its place as the world's biggest smartphone maker to Samsung.
And the fate of cross-channel ferry operator Sea France is back in the hands of the courts this Monday. A judge here in Paris has to decide whether the bankrupt company has to now be liquidated. Plans to turn it into a workers' cooperative using staff redundancy money have stalled, as only a third of them are supporting it.
Now, for much of the last 3 years, the US car industry has been on its knees, unable to sell in even its own backyard. But times are changing. Detroit's big three, GM, Ford and Chrysler, recorded their best December for years. So they head to their home city auto show Monday with renewed optimism. Ben Barnier has more.
2 years ago, production had stopped at this Chrysler factory. Today, 1,800 workers assembled Jeeps. Production resumed after the US government came to the rescue, and the Italian car maker Fiat took over Chrysler, saving the company from bankruptcy. The average employee here works 60 hours a week, earning more than 5,000 euros a month.
I'm working full time. I'm not laid off. I'm one of the fortunate. I'm working every day.
In 2011, sales jumped by a third. To keep up with demand, the company plans to hire another 1,000 employees. In recent months, the big three, GM, Chrysler and Ford, have been selling more cars. A growth largely driven by high demand in Asia. As for American customers, many of them have shifted gears towards smaller cars.
We are selling more small cars than we did before, primarily because of fuel economy and gas prices in the United States. However, we have many consumers that still want or need large vehicles and pickup trucks.
Despite a pickup in sales, experts predict the industry will need another 3 years to fully recover from the financial crisis.
And of course, we'll be bringing you the latest on all the models on display at the Detroit Auto Show. Opens to the media this Monday. Our correspondent Nathan King will be there. Look out for what Fiat are doing this year. It's their first Detroit Auto Show since they took full control of Chrysler. Some big plans for the kind of European cars that they're hoping to make a success of there on the roads of the US.
All right, thanks very much, Owen, for that look at the day's business news. That's it for this half hour of Live from Paris. All the latest headlines coming up in just a few minutes, and that's with Stuart Norville. Don't go away.